Good morning. Today is October 11th. Let's get started. So, the problem we had in September 2008 was we really did not have any legal tools or policy tools that allowed us to let Bear Stearns and AIG and the other firms go bankrupt in a way that would not cause incredible damage to the rest of the system. And therefore, we chose the lesser of two evils and prevented AIG from failing. That being said, we want to be sure that this never happens again. We want to be sure that the system is changed so that if a large critical, systemically critical firm like AIG comes under this kind of pressure in the future, there will be a safe way to let it fail so that it can fail and the consequences of its mistakes can be borne by its management and shareholders and creditors without bringing down the whole financial system. Finally, let me say a few words about the consequences of the crisis. We did stop the meltdown. We avoided that we would have been, I think, a collapse of the global financial system. That was obviously a good thing. But one thing that I was always sure of, and the Federal Reserve was always sure of, was that a collapse of some of these big financial firms was going to have very serious collateral consequences. There were people arguing even as late as September 2008, well, why don't you just let the firms collapse? There is a system that can take care of it, bankruptcy. Why don't you let them fail? We never thought that was a good option, particularly if the whole system had collapsed, we would have had extraordinary serious consequences. As it was, even though we prevented a total meltdown, there were still very serious collateral impacts, not just on the US economy, but on the global economy as well. So, following the crisis, even though the crisis was brought under control, the US economy and much of the global economy went into a sharp recession. US GDP fell by more than 5%, which is quite a deep recession. 8.5 million people lost their jobs, and unemployment rose to 10%. And as I said, this was not just a US situation. The US recession was, in fact, a larger average recession. Many countries around the world had worse declines, particularly those dependent on international trade. So it was a global slowdown. And as all this was happening, fears of another Great Depression were very rare. Nevertheless, the Great Depression was much worse than the recent recession, and I think the view is increasingly gaining acceptance that without the forceful policy response that stabilized the financial system in 2008 and early 2009, we could have had a very we could have had a much worse outcome in the economy. I will close with a couple of indicators to compare the recent recessions with the Great Depression. First, figure 28 shows the shocks. First, figure 28 shows the stock market. The darker line starts in August 1929, which was the peak of the stock market before the Great Depression. The lighter line shows the more recent stock prices starting in October 2007, and then each of the graphs shows you the evolution of stock prices in the depression period and in the more recent period. What is striking is that for the first 15th or 16th month, stock prices in the United States behaved in this crisis very much as they did in 1929 and 1930. But about 15 or 16 months into the recent crisis in early 2009, about the time that the financial crisis was stabilizing, look what happened. In the Depression era, stock prices kept falling, and as I mentioned, in the end, stock prices lost 85% of their value. In the recent crisis, by contrast, US stock prices recovered and began a long recovery, and they now are more than double where they were 3 years ago. Figure 29 shows industrial production, a measure of output. Again, the lighter line graphs, the more recent data, the darker line graphs, the Depression era data. You can see that this recent crisis, the fall in industrial production was not quite as severe or as fast as in the Depression, but you get the same basic phenomenon that about 15 to 16 months into the episode, about the time that the financial crisis was brought under control, industrial production bottomed out and began a period of steady recovery, whereas in the Depression, the collapse continued. The collapse continued for several more years. Student, in a question, in both this lecture and the previous one, you mentioned the increasing issuance of exotic and subprime mortgages. Why the financial institution willing to bear so much risk to lend even to borrowers with poor credit? And if they had foreseen the decreasing prices in the housing market, why they would they still have made those loans? Chairman Bernanke answer, there were a couple of reasons. One was simply the fact that firms were probably too confident about house price increases and said, well, house prices are likely to keep rising. And in a world in which house prices are rising, these are not such bad products because people can afford to pay for a year, but then they can refinance to something more stable. And this may be a way to get people into housing. But the risk was that house prices would not keep rising, and of course, that is ultimately what happened. The second reason was that the demand for securitized products grew very substantially during this period. In part, there was a large international demand from Europe and from Asia for high quality assets, and always clever US financial firms figured out that they could take a variety of different kinds of underlying assets, whether subprime mortgages or whatever, and through the miracle of financial engineering, they could create from them at least some securities that would be rated AAA, which they could then sell abroad to other investors. Or unfortunately, that sometimes left them with the remaining bad pieces, which they kept or sold to some other financial firm. So there were trends in the financial markets, including overconfidence about their ability to manage those risks, a belief that house prices would probably keep rising, a sense that after they made those mortgages, they could sell them to somebody else, and that other investor would be willing to acquire them. A big demand for safe assets. For those reasons, it was actually a very profitable activity while it lasted. It was only when house prices began to fall that it became a big loser. Question. You were talking about how one of the major things the Fed had to do was figure out how to get liquidity flowing again in the market. That reminds me of the Volcker rule, because as I understand it, the Volcker rule bans proprietary propriety trading, proprietary. The Volcker rule bans proprietary trading by investment banks, but it also left gray areas for principal trades, which, as I understand, is very important for market makers to create markets and find liquidity. So I wonder what you think about that. Doesn't that seem rather counterintuitive? That's a very good question, and I don't know how to answer it. Answer. Well, the Volcker rule is a part of the Dodd-Frank financial regulatory reform, which the Fed and other agencies are tasked with implementing. The purpose of Volcker rule, as you said, is to reduce the risks of financial institutions by preventing banks and their affiliates from doing proprietary trading. Proprietary trading, which means doing short term trading on their own accounts. The Dodd-Frank law recognizes that there are legitimate reasons that banks might want to acquire short term securities, and it makes certain exceptions for them. They include, for example, hedging against risk, but one particular exception is to make markets so serve as intermediaries who buy and sell in order to create liquidity in a particular market that is exempt from the Volcker rule. One of the challenges of implementing this rule is trying to figure out how to create a set of standards that allows the so-called exempt or legitimate activities, such as market making and hedging, while ruling out proprietary trading. That is very difficult, and we are working on that. We put out a rule and we have gotten thousands of comments, which we are looking at to figure out how best to do that. But the point you raised is that liquidity in markets is important. During the crisis, it was a much worse problem than just a lack of trading volume. You had big financial institutions unable to find the funding to support their asset positions, which left them with two possibilities: either defaulting because they do not have enough funding, or the tack that many of them took, selling off assets as quickly as possible, which in turn spreads panic. Because if there is a huge seller's market for, say, commercial real estate bonds, that is going to derive the price down very sharply. And then any company that is holding those bonds finds its financial position being eroded, and that creates pressure on it. I did not use the word contagion in my discussion. A contagion, just as in an illness context, is the spreading of panic, the spreading of fear from one market or institution to another. Contagion has been a major problem in many financial panics, and certainly in this one. That was one of the mechanism that caused funding pressures to jump from firm to firm and created such a broad-based problem. So contagion means the pecuniary externality, I guess. Right, Ben Bernanke and Diamond and Big won Nobel Prize. I was wondering why Mark Goldler didn't win the Nobel Prize alongside with Bernanke, but if Gertler won the prize this year, then they should have given Kiyotaki as well, I think, alongside with Gertler. Then that would have made the Nobel Prize winner like 5 people in the same year, and that's unprecedented. So maybe or maybe not. That's just the feeling. 5 is too many. So next time, maybe or not. Darren Acemoglu and their fan must have been disappointed. Well, we will see.